In 2020, millions of investors panic sold their entire portfolios. The market dropped 34% in 33 days. People were terrified. They sold everything. And then, the market recovered in just 5 months. The people who sold locked in their losses forever. The people who held, or better yet bought more, made life-changing returns. So why did so many smart people make such a devastating mistake? It wasn't bad math. It wasn't lack of information. It was something much harder to fix. It was their own brain. And today, I'm going to show you exactly how your mind is secretly working against your wealth, and more importantly, what you can do about it. Here's something the finance industry doesn't talk about enough. Your brain was not built for investing. It was built for survival. Thousands of years ago, if something looked dangerous, you ran. Fast decisions kept you alive. But in investing, fast emotional decisions kill your portfolio. The mental shortcuts your brain uses, called cognitive biases, made perfect sense on the savannah. They make zero sense when you're staring at a stock chart. There are dozens of these biases, but there are 5 that are absolutely destroying beginner investors right now. And the scary part? You're probably falling for at least 2 or 3 of them without even knowing it. Let's go through them one by one. Bias number 1 is called loss aversion. Here's a simple question. Would you rather win $100 or avoid losing $100? Studies show that psychologically, losing $100 feels about twice as painful as gaining $100 feels good. Read that again. Twice as painful. So what happens when your investment drops 10%? Your brain screams danger, get out now. Not because it's the smart move, but because the pain of losing feels unbearable. This is exactly why people sold in March 2020. They couldn't tolerate the feeling of watching numbers go red. The decision wasn't logical, it was emotional, and it cost them everything. Bias number 2 is called herd mentality. In 1999, everyone was buying .com stocks. Your neighbor was doing it, your coworker was doing it, Reddit threads were exploding. It felt safe because everyone was doing it. If a lion is chasing a herd and you're in the herd, you're statistically safer. That instinct is ancient and powerful. But in markets, when everyone is piling into the same trade, that's usually the moment right before the crash. By the time something is popular enough that your taxi driver is recommending it, the smart money has already left the building. Remember GameStop in 2021? Thousands of beginners piled in at the top and lost fortunes when the hype died. Bias number 3 is called confirmation bias. This one is subtle but brutal. Once you buy a stock, your brain starts looking for information that proves you made a great decision. You ignore the negative news. You skip the critical analyst reports. You only watch the YouTube channels that say your stock is going to the moon. Your brain isn't lying to you on purpose. It genuinely filters reality to protect your ego. The result is that you hold a losing position way too long because every piece of information you consume is telling you to hold on. The fix is forcing yourself to actively search for the bear case. Find the smartest critic of your investment and genuinely listen to them before making any decision. Bias number 4 is called anchoring. Imagine you bought a stock at $100. It drops to $60. Your brain is now anchored to that $100 price. You think to yourself, I'll sell when it gets back to $100. But why? The market doesn't know what you paid. It doesn't care. The only question that matters is this stock worth holding at its current price, given what I know right now? Anchoring makes people hold losers indefinitely, waiting to break even on a number that has zero meaning to the market. Traders call this waiting to get back to even, and it is one of the single most expensive mental traps in all of investing. The past price is irrelevant. Only future value matters. Bias number 5 is called recency bias. Whatever happened most recently feels like it will happen forever. If the market went up for 12 straight months, your brain starts to believe the market always goes up. Risk feels like a myth. And if the market crashed last week, your brain starts to believe it will crash forever. Every day feels like the apocalypse. This is why people buy at peaks and sell at bottoms every single time. They're not reacting to data. They're reacting to what just happened. Recency bias is the reason the average investor earns significantly less than the market itself, even when they're invested in the exact same funds. The market's recent past is the worst predictor of its future. So now you know the 5 biases. But knowing isn't enough. Here's what actually works. First, write down your investing thesis before you buy anything. Why are you buying this? What would have to happen for you to sell? Set those rules in advance when your emotions are calm. Second, build a waiting period. If you feel a strong urge to buy or sell, wait 48 hours. Most emotional investing decisions evaporate on their own within 2 days. Third, keep an investing journal. Document every decision and the emotion you felt when you made it. After 6 months, you will start to see patterns in your own psychology that will shock you. Self-awareness is the foundation of every great investor. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." That's not just a catchy quote. It's a direct antidote to herd mentality and recency bias. The best investors in the world are not smarter than you about spreadsheets. They are better at managing their own emotional reactions. They have systems that remove emotion from the equation. They know that the market is essentially a machine that transfers money from impatient people to patient people. The edge in investing isn't secret information. It's emotional discipline practiced consistently over time. That is accessible to literally anyone watching this right now. You don't need a finance degree. You need self-control. Here's the truth nobody tells you when you're starting out. The market will test your psychology constantly. It will show you scary headlines. It will show you friends getting rich on meme stocks. It will show you your portfolio bleeding red on the worst possible days. Every single one of those moments is a test. And now you know what's actually happening in your brain when those tests arrive. You can name it: loss aversion, herd mentality, confirmation bias, anchoring, recency bias. Naming a bias in real time is the first step to defeating it. If this video helped you see your own investing behavior a little more clearly, consider sharing it with someone who's just getting started. They might not know it yet,